Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good day, everyone. Ira Epstein, and here we are getting on to 2:40 in the afternoon on Thursday, and this is August 18th, 2011. And boy, we've got a big down day at this point in time. May get some short covering going into the end, or you may get another round of selling. Hard to tell. You've had a lot of bids going into the Treasury instruments, so we know are several things. Number one, the Fed's program of flattening out these curve yields, keeping them down, fully at work at this point in time. Second thing, you're looking at all this volatility. You know, I'm amazed that the regulators aren't looking at this high-frequency trading. I'm still not convinced the good it does anybody but those people. And it's not like the old days of the market makers. About 4 years ago, we lost that uptick rule. And what you're looking at now is they dominate the day and they put fear into everyone. And they don't go home with positions, I bet. I don't know. I don't look at their books. But that's my guess. And at some point, somebody should stand up here and say, what good is that? It's really not making a market. And I think that there's going to be a call for it. I try to be ahead of the curve and tell you these things. That's what I'm seeing. Gold. I have missed this. I thought this market was going to give a pullback. You're not getting any at all. Today, what's making this all happen, of course, is fear about the banking systems in Europe. Then we're looking at our own numbers. If you saw the Philadelphia numbers come out today, they were just terrible. If you're continuing to look at anything in jobless claims, they're rising again. And the housing data that's coming out is way less than stellar. You put the combination together, you're in the middle of summer, coming to the end, you got thinner type trading normally at this time of the year. Maybe if you threw out all those numbers from those program traders, you'd understand that and see where we're at. So instead of going to the daily charts I normally do, I think it's time to revisit where the markets are in a bigger perspective. This is the E-mini S&P, a weekly chart. As I view the chart, what's happening right now is the market made a peak, broke down, took out this low, made a new low, and has rallied up this week over last week's high. Now, whatever the market does, if it finishes near the week's low, and this is what I'll be looking for, if it finishes near the week's low and takes out Sunday night, Monday, Tuesday, that low, we're going to get a lower high. And it's going to be this week's high, which is 1206.75. And you're way down from there. You're at 1132 right now. And I just look at it that you're under the Bollinger Band. So the odds of staying under that very long, they're not great. Can the market go down and re-challenge the 1077? Absolutely. I wanted to get rid of the noise of the daily charts. You can see that the weekly charts are still very much in the bear camp, but on a weekly basis, they're starting to get a bit oversold. This is the monthly chart of the E-mini S&P, and this verifies, in my opinion at least, that you've seen the roll. This chart turned a bit earlier, if you'll notice. And for the month, this has been a breakdown month in the chart. You're down to the 45-month moving average of closes, and you might be going back to the 1,000 level, which is the overall, number one, it's an even number. Number two, it's a Bollinger Band bottom, and that's 133 points from here. Just what the chart is showing. The NASDAQ weekly did just what we saw on the S&P. It came down on the big washout, rallied a bit higher this week, and it's dropping. I expect the same type of game plan to develop there. The 100-week moving average of closes is 2038. I think that's the potential first support zone for the market. And if you take out 1972, I don't know where it's going. The fact that it's under the Bollinger Band just tells me that markets don't like to stay under that, so you don't get overly bearish on the monthly chart down there. On the monthly chart, that chart I just showed you was weekly. I hope I said that right. On the monthly chart, you've rolled over as well. You can see you lost your embedded stochastic. The bull market that began about midway through 2010 on this chart is over. It's past tense. It's going to take a lot of work to get it going. And the question is now, as the market breaks away from the 18-month moving average and the momentum's moving down, how much lower? I see support 1824 down to 1683. That's about 400 NASDAQ points lower. On the Dow weekly chart, again, my first thing I see is you're under the Bollinger Band, which you don't typically stay under or over that if you go back in time. I think you'd agree with me. I'll just step back off camera. That's the first thing my eye catches. The second thing, we are getting a bit oversold, and we're through some key numbers. That's the 100-week moving average of closes. So you're under all this. Bounces in the market, depends on how the market reacts. But I would expect that on that chart, and I'll bring it back, that if we can take out whatever this week's lows are, that will make the new swing line high that number. And if you take out those swing line highs eventually, that's what will get, I think, technically, the bears out of the market. Right now, I see them in full control. On the monthly chart on the Dow, it's the same thing. It's rolled over. You got lower highs. You certainly have lower lows. You're into your very, very first support zone of the 100-day, and I'm saying day, 100-month and 45-month moving average of closes. The green is the 100, the blue is the 45, and you've rolled over the momentum here. So the longer-term charts are very, very bearish. You don't need me to tell you that, but that's where it's at. You're going to hear value players come out in these markets, and they're going to say once again, and I know they are, they're going to say that buy the big break if you can get it. You maybe get into 7 to 9 times earnings and get dividends that pay 3 to 5%. I got to tell you, they're right. They're not wrong. They're right. Got to let the market come down. Where they're wrong is thinking that the market had bottomed. Their value play is, I think, a good idea because with 30-year bonds and 10-year bonds collapsing, 10 years went under 2% today. That gives you an idea. And that's proof in its own way that it's not the American banking system, contrary to what you're going to hear all over, that is wrong. It's the world's banking system. It's what's going on in Europe. And people are rushing to America to buy our bonds because at the end of the day, they're going to get their money back. The rates are going to be terrible, but that in turn, with a lower dollar ultimately, and the word is ultimately, today people are running to it for safe haven, but they do that every other day. Ultimately, that low dollar, low interest rates were very attractive to invest in. You watch. Over time, that's what will, I predict, take place. Okay, let's take a look at the next chart, which is the bond market. You can see, take a look there. This defies what the so-called pundits of interest rates thought. People were getting out of these markets here, thinking it could never get up there and that eventually U.S. interest rates have to climb. They haven't at this point in time, so the timing, I guess, was everything. And timing reminds me to talk to you about strike prices, what options are, before I get too far into this. And we do have an introduction to options piece, and that piece is in our futures trading kit. It will tell you about puts, calls. Why am I mentioning that? Because somewhere along the line, there's going to be an opportunity to start using some of these strategies. And those strategies, especially if you think that the market's going to go directional. I don't know what these markets are doing right now. Gold is directional. Bonds, notes, they're directional. Stocks, if you've sold or bought them in the past 2 weeks, you've probably at one point been ahead either way that you made that trade. And a number of other markets are now watching what's going on in the financials, and they're getting scared. So it's a good time to learn about what those are doing. Here's the corn market. And corn today was down 12 cents. Now, I personally think that the corn chart, when it took out 712.5 and closed near those lows, is telling you, okay, getting through this Bollinger Band is very difficult. Why? The odds of getting through the black lines on the upside or downside and staying there 2.5% of the time. Riding the band is one thing, but what's the pattern? You had higher highs. You had, up until today, and I'll remove this, higher lows. Once you break that pattern, and you get the stochastics turning down, I really don't care what the market does for the next few days. I think the momentum's out of the market. And I'd love to see the market start pulling back and start taking out some of this premium so that the reports that come in on corn, which I happen to think will be bullish, might give an opportunity for those that wait and let the summer noise of the market get away from us. Well, with that, I'm Ira Epstein. I will talk to you all tomorrow at this time. Barry Rosen of FortuneCast will be on today, so I'll be recording that, and we should have his tape up, I'm going to say around 5 o'clock Chicago time at the latest. Have yourself a good day.